Hello, friends. So we are about to enter into one of the most riskiest time in the market. Now we are pretty much at the end of August. So we got September, then we got October. And typically during these 2 months, at some point we get hit with a midterm election. So a lot of hedge fund managers, a lot of people who manage wealth for other people, they take a defensive posture. But I think this year is a little bit different. It's different because there's a lot more education, there's a lot more information available to people. For example, a lot of people know that typically during midterms, the market crashes. So a lot of people I've been talking to, they have already taken a defensive posture. They are not into the market. And that's why you're seeing, for example, after we saw what happened with situational awareness, the market kind of jumped back up for a little bit and then it kind of chilled out. And the main reason for that is because nobody wants to jump on a ship which may crash over the next month or a month or two. So a lot of people are taking defensive position right now. So I don't know if we are really going to see the same kind of impact that we typically see during midterms. In matter of fact, what we saw during situational awareness, that might have been the maximum pain for this year. That is my base case right now. Because see, if you think about that, we saw a big deleveraging event. And those of us who survived that deleveraging event, you probably thinking that, hey, if there is another opportunity like this, that would be a good buying opportunity. I don't want to sell out of my stocks because the market is still very solid. For example, a lot of people that I talk to, especially in the world of finance, their fear was as soon as the yields on bonds will hit 4.5%, that is when market is going to crash. Well, guess what? It did hit 4.5% and market is back to all-time highs, so no damage done. So people are starting to realize that this market actually have a lot of legs. This AI trade have a lot of legs. Yes, it creates panic every now and then, but overall, when you listen to the earnings report of major companies out there, what you hear is, oh, we are getting big benefit in productivity, we are reducing our costs, we are starting to generate revenue, and those kind of messages are starting to grow. So typically speaking, rising real yields partly affects the economic strength, right? Because obviously at what rate we borrow makes a lot of difference. So the question now comes is, what are Fed going to do? Are they going to continue to increase the interest rates? They're going to take a chill pill. Where are we going with this? And the intervention we saw by the Treasury last week, where he announced that we are going to increase the buybacks from 20 billion to 40 billion. And not just that, he said, we could do even more. And basically telling us that they're very committed to lowering the interest rate, at least on the bond side. It doesn't really directly impact our day-to-day interest rate, but that's what the Treasury told us. Now, essentially, that strategy is like borrowing from your credit card and paying your mortgage. I think a lot of those old bonds that government is buying, they're higher interest rate and now they're buying them back. So that's a problem. And now they're going to issue the more debt on a shorter term. So that's what Treasury is planning on doing. So it's basically just rotating that money. But the way they put it is that, hey, look, we are just adding liquidity into the market. And one of the things you probably have seen is that gold and Bitcoin rallied. In matter of fact, the way Bitcoin rallied might have puzzled a lot of people. I know a lot of people who are anti-Bitcoin. They thought that this is the end of the Bitcoin. Nobody was expecting it to run crazy like this, but it was very surprising. And the reason behind that is that finally people are starting to realize that government simply can't afford higher interest rates because, take a look at what's happening with Japan. Even if Japan wanted to increase the interest rate, they can't because that is going to put so much burden on the overall financial system of the government that they won't have money left for other things. Like take an example in the United States. I mean, we are sitting at $40 trillion debt. If things to get more worse, what happens? Let's say if we increase the interest rate. Well, guess what? The housing market slows down, the construction slows down, people who are borrowing, building businesses, they are going to slow down. So essentially, when economy gets slowed down, the tax revenue also slows down. And when you have such a big debt and you need to pay that interest payments and you don't have any income, that even creates a bigger problem. So keeping that interest rate under control is in government's best interest. Now, that doesn't mean that in a short-term market can't correct. It certainly can at any time. There could be a news, there could be some sort of panic trigger that can force people to take corrective action. But overall, if you zoom out maybe 6 months, a year down the road, the U.S. government has to keep the economy healthy by either funding the bond market or bringing liquidity into market some other way, because they cannot afford to go in recession, especially now when we have so much debt. Now, let's just say it does happen, and let's say the government does lose track of it or control of it, then yes, we are looking at a pretty bad recession. Interestingly, when I talk to professionals who are in the world of finance, this is their biggest worry. They're starting to feel like the Feds are actually losing control of bond market, meaning that what if, regardless of what intervention Treasury does, if the bond prices don't come down or the yields don't come down, if they stick over 4.5% for longer, then what happens? This is one thing that is keeping a lot of hedge fund managers, a lot of professional investors from getting into the market. So on one side, they're hedging themselves, they're protecting themselves right now. On the other side, that means there's a lot of capital sitting that is ready to jump back into the market. So as soon as, we get a clear indication as to what governments plan to do and how are they going to resolve the crisis, you're going to see market jump really fast. Now, maybe that happens toward the end of the year, or maybe that happens early in the year. So we don't know yet. It really all going to depend upon what the midterm is going to look like. So that is the state of economy right now. So if you think about, if you were a professional money manager, would you really jump into the market right now? Wouldn't you rather wait and see what happens a couple months down the road? So I don't expect market to go a lot higher over the next 6 to 8 weeks. In matter of fact, there is a bigger risk of a downside correction. Now, that doesn't mean we will see the correction, but people are just going to be on sidelines. So that means we're going to see a little bit of a struggle over the next 6 to 8 weeks. So that is the state of economy right now. Another big concern that has obviously been bothering the market for a while now is all this investment that we're making in this AI trade. Is that really going to pay off? So let's take a look at Meta. Meta is, I generally call it the cash cow. It's always printing money. They got a money printer out there. And obviously, it's under pressure right now because of the lawsuit that is going on. But regardless of the lawsuit, if you take a look at the revenue, such a big company, and revenue even today increased by 28%. And this is without any kind of contribution from AI. Well, I would say some contribution, meaning they're able to increase, get more people to engage in advertisement. But what I'm saying is it's not like they're really selling a model right now, or they're selling a lot of hardware space or anything like that. They're not into any of that business. But if they were to get into that business, they start really charging for some sort of AI product. They start producing some sort of system where people can rent the compute from them. That can be an additional source of revenue, and Meta is certainly open to that idea. So that is pretty exciting, 28% growth for such a large company. But then I also have to take a look at their expenses. So this is a simple trick that you can always use. Oftentimes people kind of focus on what percentage a company's revenue is increasing, but you also want to take a look at what percentage expenses are increasing. And if expenses are increasing faster than the income, that is a problem. What we would rather have is we want to see income growing and we want to see expenses falling. And then we also have this debate around depreciation and investments into other companies. Like if you take a look at Amazon and Google, they did a lot of investments in these frontier models, right? And they are actually showing that on their balance sheet that, hey, our income has increased. But in reality, their income really hasn't increased. Okay, let me correct myself. Their income has increased, right? But it hasn't increased the way they're showing it on paper, because a lot of that is paper money. It's coming from growth in the valuation of OpenAI and Anthropic. So meaning in one way, those numbers are fake. So let's just say if something bad happens and Anthropic and OpenAI bets don't really work out, then all these companies that are showing the investment in these companies on their balance sheet, well, they're never going to be able to collect that dollar. So that those numbers are actually fake. And obviously that is going to hurt the stock as well. So, if you are invested into Google, Meta, Amazon, all of these large companies, you really do need AI to be successful. If that doesn't happen, there is no safe place. They are all going to hurt. Now, one place that I'm heavily invested in over the last year or so is biotech. And one of the reasons behind that is because biotech sector I think is going to be a great beneficiary of. They're able to do drug discoveries faster. They're able to come up with new applications. They're able to reduce the cost of research. So I think that is one sector that's going to be heavily beneficial. But one of the problems with biotech sector is that it's kind of like a lottery. Either it works or it doesn't work. In matter of fact, most people that I know who invest in biotech actually suffer. So you do need to have a system that can kind of get you a little bit more closer to the winning line. Now, luckily for us, all the biotech stocks that we invested in worked out really well, which we should not really take for granted. But there is a system that I do follow, so that does help me keeping my losses under control. So that is one sector that I'm super excited about. So if you don't want to be now, if market were to correct, it's not like biotech will remain up and everything else will crash. No, biotech is going to crash just along with it because there's going to be a liquidity problem in the market. When people start selling, they start selling everything. They don't really analyze what is going to work, what is not going to work. So I do expect that sector to do really, really well over the next couple of years. Then we have financials. Financials are doing really well. I mean, take a look at, a lot of brokerage firms. And I have talked about you really want to pay attention to the ER of financial companies because they tell you the overall health of the economy. Those stocks are doing really well. Many of you guys are already in AI trade. Yeah, it's up and down. It's never really in a straight line and all that. But overall, if you look from the starting of the year till now, AI trade is doing really well. And on that topic, in matter of fact, a lot of AI growth stocks has already corrected. They never really made it to their all-time high yet. So I don't expect them to do that anytime soon, maybe towards the end of the year, but certainly not over the next couple of months. I will expect them to struggle. But this is a great opportunity for those of you guys who don't have any kind of exposure to AI trade to pick companies that you think are going to do really well over the next 24 months. So AI trade is still alive and well. Now, on that topic, let me remind you guys, I'm not an investment advisor, so I cannot tell you whether you should buy something or not buy something. I run a coaching program where I teach people how to think about these things on a regular basis. So we meet every 2 weeks. So for example, we're actually meeting today. We're going to talk about, I have analyzed roughly about 30, 40 companies over the last couple of weeks. So I'm going to share some of the major highlights from each one of those companies. Not that we're invested in those companies. The idea is so people can understand what are these companies telling us. So one thing is, so there are two basic systems that I use to analyze where I want to be. A lot of people think that's financials, that's valuations, that's some metrics. But like Anindya Bhai said the other day on WhatsApp, some of these traditional formulas that used to work in the past don't work anymore. So if you're going to try to buy a company based on PE or forward PE or PEG ratio or something else, most likely you are going to struggle because market hasn't performed that way for many, many years now. Is one day everything going to go back the old way? Possible. I don't know. But at least it hasn't behaved that way for many, many years. So what do I do? So I look at two things. Number one, I look at the story. Where does the story come? Not the story that CNBC tells you, not the story that you hear on Twitter or YouTube or elsewhere. You want to make your own story. How do you make your own story? Very simple. You listen to the ER of all the good companies out there, or certainly even bad companies. And these days, you even have tools like AI tools, and you can quickly extract. And I'll talk about that just in a second here. So you can get a lot of information out of that. And if you do it to 30, 40, 50 companies, I think you can come up with your own story. Like, for example, you can take an ER of all these companies, dump into ChatGPT or Claude or something else that you use, and you can say, hey, tell me, overall sense of economy. Give me some highlights as to what is positive and what are some of the concerns that these CEOs are telling me. So you put that and you get some basic understanding as to what's happening out there. This is your own story. This is now you actually have a conviction, okay? Second thing I look at is where are people putting their money in? So for example, earlier when AI trade was really damaged, we were actually loading up on AI trade. Why? Because insiders were buying AI trade like crazy, and then gold was corrected. So I've been talking about that in our group for almost last 3 months now that, hey, look, gold, industrials are very expensive. But if I take a look at gold and financials, they're super cheap right now because this is the time to load up. So you want to buy things when market doesn't want to buy it, and then just wait. Now it doesn't have to recover right away. Sometimes it takes 3 months, 6 months. Sometimes it can take a year or two. Luckily, these days, for last few years, we are recovering relatively fast. And I think one of the reasons behind that is because there are a lot of people who play the stock market using options and futures and all kind of other fancy derivative tools out there. That means they're only there for a little bit, and they want to jump ships. If oil is hot, they want to sell gold and get into oil. If AI is hard, then they want to sell oil and then jump into gold and stuff like that. And which is fine. That's one way to do your trading. But I think the easier way to make money is just holding on to your stocks. That's what I have seen. It gives you less headache, gives you less pain. You don't have to spend. I mean, a lot of you guys are full-time employees. You don't have time to make all of those decisions. So you own 20, 25, maybe 30 companies. You're well diversified into different areas, different stories. And, sometime gold going to be down, sometime financial is going to be down, sometime AI going to be down. And that's the time when you add. And then when market is going up, you chill, you wait for the next opportunity to get back in. So that is what we do in the coaching program. And again, I can literally write a book on this and give you the exact steps. But honestly speaking, it's really more about observing and practicing. Like, you have to feel the pain. You have to feel, how does it feel like when a stock you bought goes down? Like, for example, I was reading one of the Peter Lynch classic yesterday. I don't remember which book it was, but it's one of the very popular books. I love all Peter Lynch books, by the way. And he was talking about, like in 1980s, he bought a company called Kaiser Industries, and he got in at $13. So he thought, stock is a great buy at $13. And a few months later, the stock dropped to $11. And he goes like, oh my God, this is a super cheap. And by the way, when he got into that $13, this was one of the largest purchases in a single transaction by Fidelity in those days. So you can just imagine, I'm sure at that time, Peter Lynch must have been a young analyst. And he makes a recommendation to his company that, hey, let's buy this Kaiser Industries. And the stock keeps going down. So you can imagine how he must have felt, or how Fidelity must have felt. But Peter Lynch said, hey, look, the company is solid. The trend is good. This is a good stuff. Guess what? The stock dropped down to like $8 or $7 a few months later. So you can see from 13 to 7, that has been very painful for him, especially being a young advisor. You can imagine how he must have felt. But what does Peter Lynch do? He wrote in the book that I called my mom and I say, hey, whatever savings you have, go buy the stock. This is just too cheap. There's no way it can drop anymore. It's going to bounce from here. It's going to go up. And luckily, his mom did not act on his advice. But the stock dropped, I think, from $7 to $3. Can you imagine? You bought it at $13 and stock dropped to $3. Now, luckily, he was convincing enough to tell Fidelity that it's still a good buy. If it was a good buy at $13, it's certainly a good buy at $3. And people don't realize this, by the way. When they get into a company, they don't realize that, at whatever price you bought it at, you think that's a fair price. So the only question you really need to answer is, did you overpaid for the stock or not? Just because stock is available cheaper a couple of months later doesn't mean that you made a mistake. That's just market doing what it does. It just does crazy things. That is the price you pay to stay in the market. And I want to say, I think a year or 2 years down the road, that stock recovered and went to, I think, $30, $40 stock. So Fidelity certainly made 3x, 4x on their money. So it worked out to be a great trade, but not without seeing that kind of pain. So keep those kind of things in market. Nobody really knows what is going to happen with the stock in the short term. But what we can do is pay attention to the long-term trend, where we are going, keep an eye out on it. And when market gives us an opportunity, we take advantage of that and we load up on what we want to buy. So I hope you find this helpful. And again, I do have a couple of events. So for example, this Saturday or this Thursday, Friday, I'm going to be at an ISACA conference for security. I also have 2 meetups set up. On Friday, we will meet up in Sunnyvale. And then on Saturday, we are going to meet up in Dublin, Pleasanton area. So we have those 2 meetups, and obviously all of those you guys who are coming to ISACA conference, I'll see you guys there as well. My intention is to learn more about security, because security is such a big field, and with the agentic AI and all that, I think security sector is going to see. Now, talking about security, by the way, perhaps is one of the most overvalued sector right now. So I'm actually thinking about trimming some of my exposure to it, because those stocks are up I think almost everything is up more than 100% over the last few months. So if I were to see some correction, most likely those areas will get impacted because people have made a lot of money. So they probably want to sell this and buy something else. So that's what I'm thinking might happen there. So that's what the state of economy right now is. I hope you find helpful. And then if I can be of any help to you, if I can answer any questions, reach out to me. You can reach out to me via taxcodeadvisors.com and, see me in person. And then obviously Wealth Summit on October 25th. Don't forget that. So I'm looking forward to seeing you, all of you guys who are part of my group, whether on WhatsApp or Discord. You guys have access to a special link. So you get a special pricing for Wealth Summit. So take advantage of that. I'll be there whole day long answering your questions. We can talk about it. A lot of interesting things that are going to happen in 2027. Thank you so much, guys, and I'll see you soon.